Yeah, so what we're talking about today, we're really tying it all together as a statement of cash flows. So there's an irony to the statement of cash flows. We have been doing everything on an accrual basis up to this point, right? The whole point of accounting was to give some kind of conformity to businesses as a whole, right? That's why we have GAAP, generally accepted accounting principles. That's why we use accrual-based accounting, where we recognize revenue as performance obligations are satisfied or as revenues earned, and while we match expenses to the revenues that are created, and all of those other fundamental principles we talked about in chapter 1. But at the end of the day, because accrual accounting is based off estimations and it's based off of these principles, it doesn't reconcile the cash flows. It doesn't tell us exactly how the cash is operating in the business and how it's being used. And so we create a financial statement to reconcile back to a cash basis. So we take it all away from the accrual-based accounting and go back to cash basis. And so you'll get these interesting issues in real practice where you'll meet, if you're working with smaller clients, most of your clients won't be using accrual basis, and you'll have to take them from a cash basis. You'll have them on a cash basis, and you'll have literally have all their receipts and bank statements, and you'll have to move them to an accrual basis. While your more sophisticated clients are normally on an accrual basis of accounting, GAAP, and you need to take them back to cash basis. Because we want to report both, we have a statement called the statement of cash flows. In my perspective, this is one of the more valuable statements. Right? It tells us really, if I'm going to look at a company, one of the first things I look at is their statement of cash flows. I'm curious on how, like, cash is king, and I'm curious on how they're using their cash and how they're getting their cash. And so that's answering this question. So it's not just going to show that cash is coming in and out and leaving. We're also going to classify that cash and what's useful for investors and lenders. And so the real purpose of this, and I think the most important thing, is just understand the difference between the statement of cash flows and other financial statements, and to classify the changes in balance sheet accounts as operating, investing, and financing activities. We're going to see more learning objectives on the book slides, but I think these are really the key takeaways I want at your level. This is the main interesting piece that we're going to be talking about, that there are 3 separate types of activities on the statement of cash flows, and understanding what makes them different, operating, investing, and financing, is really the essential piece that I want you to leave with. And so we already know that there's the income statement. We should know this by now, but we know that there's an order of financial statements and they're prepared in a certain way. We know that there's the income statement, which is revenue and expenses over a period of time. And that flows into our statement of retained earnings, which we learned is really a convention that we actually have a statement of shareholders' equity, and that captures the income and it flows into retained earnings. So it's measured over a period of, measures equity over a period of time, but it's really measured at a point in time, right? That's where it flows into the balance sheet account. So we see that movement and then it flows into the balance sheet account. And then that balance sheet will reflect that shareholders' equity amount as assets equal liabilities plus equity, which is that accounting equation at a point in time. And so really this is trying to capture all the transactions that occur over a period of time and then flow it into the balance sheet, which measures at a point in time, either quarterly or yearly, right? And so understanding that flow is really essential till we get to the statement of cash flows. So if we've prepared all these financial statements, we have issues. We can see revenue, we can compare it to other companies, we can compare expenses to other companies and ourselves over periods of time. We can understand where we stand from an equity perspective and how our assets and what's our capital mix, like how are our assets funded, and are they funded predominantly through equity or liabilities, and what's the status of those. But what those other statements don't answer are, how does a company receive its cash? Like, we don't know. Remember, revenue is based on earned. So we might have accounts receivable, and we don't know if we've received our cash predominantly from accounts receivable or from loans or on collection of accounts receivable. If we don't know if we have a lot of revenue but haven't collected on it, we don't know that from the income statement. So that's a deficiency that the statement of cash flow addresses. Where does a company spend its cash? We know where our expenses are, but how are we spending the cash? Are we actually paying off our loans? Are we paying up most of our cash towards our employees? We don't know that. We just know what expenses are, right? Because accrual is different from cash basis. How is cash changing, right? We'll see on the balance sheet that cash moves and changes from year to year, but how is it changing? We want to understand why it's changing and if it's being used in effective manners. And why might income increase and cash decrease? That's very common for business. Or why might income decrease, or we might have a loss, but cash increase? We want to understand that. And so, for example, if you look at Tesla's March 31st quarterly 10Q filing, this is in 2020, it posted a positive net income of 68 million, but negative cash flows from operating activities of 440 million. So good question. How can you have positive income, but then negative operating cash flows? And that's because of accrual-based accounting. And we will want to understand why by reviewing the statement of cash flows. And so I have a link in that here that you can kind of review and check it out for yourself. Let's see. Oh, let's get verification here. So you can see here the revenues. Our net income was 16. Let's see. What did I say it was here? Positive net income was 68 is here. Our net income is 68. Then if we go to our statement of cash flows, you can see we had net operating loss of 440 million. And the statement of cash flows here explains why. So you'll see all these line items, and so I'll zoom in a bit for you. But we can see all the adjustments, and we can figure out where they're getting a loss from. And so you can see that a lot of their loss is being derived from inventory. Right now, understanding financial statements, we know that from an accrual-based perspective, we capitalize inventory costs, right? We, instead of expensing it right away, we debit inventory and credit our cash, or we debit our inventory and credit our accounts payable. But from a cash basis, we still spent the cash there, right, to buy the inventory. And so from an income statement basis, that's expenses for future periods. But from a cash basis, they spent a $981 million on inventory that isn't reflected in the income statement. And so that's what drove a really large loss. So from an investor, you can see how you can now be BS proof, right? You can know that, oh, they're showing a positive net income, but they're actually using a lot of cash for inventory. And so then your question should be, hey, are they able to actually sell this inventory? Or is there a risk that some of them might be obsolete or might be go to waste because then their income might not be correctly reflected, right? And so that's where we can bring in our critical thinking. So that's the importance of the statement of cash flows. It really reconciles these differences and gives you as an investor some more clarity. So this is a question for the class. Which of the following is false? A company can have positive income and a negative cash outflow, negative income and a positive cash outflow, positive income in a period that it did not generate any cash, greater liabilities than equity, and have a positive cash flows, or none of the above. Stop sharing, let everyone think through it. Yeah, that's right. We're getting, some people are sending me answers directly to E, none of the above. Right, income, the main point here. Good job, everybody. So let me go back to it. My main point here is that income and cash flow are separate concepts. And that's what the real takeaway, like that's the whole takeaway of this class, is you should understand that GAAP-based financials and cash-based financials are different, and understand why those calculations are different. We need to understand that before we can reconcile and create a statement of cash flows. So good job, everybody. So why a statement of cash flows? There's really these 4 different financial statements, right? We have income statement. That's the whole purpose of that, is to measure the profitability of the company and to understand why the company is profitable or not. The statement of shareholders' equity is to give us a valuation concept for investors, to understand, hey, how many other investors are there? Where is the income or expenses being allocated to? Like, am I just one? If I'm an owner of Apple stock, am I just one of a trillion investors? Or if it's a locally owned partnership, do I have a majority share? And then how does that income be allocated to all of these different shareholders? Balance sheet, we're really looking for liquidity and solvency. Remember, liquidity, we're talking about the ability to meet short-term obligations, and solvency, we're talking about the ability to meet long-term obligations. And so my question is, can the company meet these obligations in the short term or long term in order to stay financially viable? And do they have a good capital allocation mix? But the statement of cash flows gives us a little bit of everything. It tells us about the performance of the company, which we don't get from the other pieces. All right, we get to really understand, is the company able to generate cash? And how are they generating cash? Are they going to generate from their operating activities, their investing activities, or their financing activities? And how they generate cash is important. Right? At the end of the day, you can have the best idea in the world. If you can't make cash or get cash to finance your idea, you don't have a business. And so I've done a lot of small business consulting, and I've been pretty tough on a lot of my clients where they might have great ideas about building a shop or building a bar, or it could be some crazy new app or product. And I tell them very, very bluntly that if you can't tell me how you can get cash for your business, you don't have a business and you shouldn't be meeting with me. Right? You need cash in some way. You either need someone to believe in your idea and finance your operations. You need money in your own pocket that you can invest in your business, or ideally your business itself should be able to generate some kind of cash flow. That's why you've heard me say many times in this class, that's why I think consulting or services are a great first-time business for people, because then you can really understand that cash is the lifeblood of a business. And that's why I really like the statement of cash flows, is that it's broken out in a really clear way. We have operating activities, investing, and financing. And students and investors get very confused about the difference between these, because there's a lot of what people can see as bleed over, but I'll make it as clear as possible for us all here. So what are operating activities? That's cash activities related to net income, right? So sales, accounts receivable, any of that. So collections of accounts receivable, it's a short-term asset. It's related to net income, right? Like accounts receivable, when you debit accounts receivable, we always credit net income, right? That for the initial transaction. Because of that, that's an operating activity. It's directly related to net income. Investing activities are cash activities related to non-current assets. Try to take away any other conception you have of investments, or else it'll confuse you. It's just non-current assets or long-term assets. So that's PP&E, intangible assets, etc. So we're saying if we are investing, if we are buying non-current assets, that's an investing activity. Financing activities are related to equity or non-current liabilities. So that's the issuance of stock, debt, etc. You need to be thinking about it. That's why we teach statement of cash flows last. So you need to be thinking about it from a balance sheet perspective in order to get this right. Otherwise, you're going to confuse yourself. Like, why is investment in plant, property, and equipment an investing activity rather than a financing activity? The reason is because it's a non-current asset. What about accounts receivable versus plant, property, and equipment? Well, accounts receivable is an operating activity because it's directly attributable to net income. And it's a short-term asset. That's kind of the way to think of it. And that gives us a good perspective, right? If it's going to be happening within a year, it makes sense that it's an operating activity and it's related to directly related to net income. If it's long-term, and if I'm buying plant, property, and equipment, if I'm buying an office or land, or if I'm buying a patent, it makes sense. Like, I'm investing in my business. If I am bringing on more partners, or if I am paying, or if I'm getting a loan, it makes sense. That's how I'm financing my business. And so we'll have inflows and outflows for each of these activities. So we'll see how we're receiving cash from our operations, and we're spending cash related to our operations. How we're receiving cash from investments, maybe we're selling the investments, or how we're getting cash back from our investments if we're selling them. Or financing, if we're paying off our long-term loans, or paying off our investors, or if we're getting cash from our investors or debtors. The other way to think of this, there's two ways that we can prepare a statement of cash flows too. There's something called the indirect method, and then there's the direct method. The direct method is the best way, but it's rarely done because it's too complex. The direct method is where we actually look at the cash flow inflows and outflows from the bank statements, right? We're actually just going to go to a company's bank statements and look at them and determine and classify all of them into their own statement, and then reconcile that, make sure it matches to the income statement. Problem is, most companies it's too complex to do that, so we use something called the indirect method. This is required, right? You have to make an indirect method statement of cash flows, or else you don't have GAAP financial statements. You need this reconciliation. The direct method is preferred, but most companies don't do it because it's too complex. The indirect method uses the conventions we've learned in this class, the accrual-based conventions, to then back into the cash-based method. So we'll know that, hey, inventory is capitalized. We know that. We know that instead of expensing the inventory, we capitalize the inventory, right? We put it on the balance sheet. We have now an inventory line item. We know that we should have used cash for it. We did use cash. We credit cash, debit inventory. But in theory, that's an outflow, right? We credited cash. So using the indirect method, for any increase in inventory, we'll back out the cash. We'll say there's a reduction in cash.